Thank you very much and good morning. I'd like to immediately invite on the panel my two panelists, Simon Taylor and Olivier ROUCLOUX. Lovely. Ladies and gentlemen, we'll each do very brief introductions. We have talked with the organisers around the time because we're starting 10 minutes late. They've suggested that we still should go for 25 minutes, but we'll determine that with yourselves as to how it flows. So, Martin Watkins, I'm the EMEA lead for exchanges and financial market infrastructure. As I saw from the show of hands earlier, not so many of you from the capital markets side. What that means is the exchanges are where you typically go to find the price on a trade, and then post-trade is the clearing and the settlement. Clearing to address the risk, settlement to get finality around who actually owns what. It's all about the plumbing that sits behind financial markets. I'm 25 years in Fintech, and in fact, 20 years ago, 3 days ago, I actually was responsible for getting Cazenove live on the new Crest system. And 20 years ago, 3 days ago, Simon was 12. It was his birthday. So I think it puts into context why, for the last 20 years, every 5, I've had a rebirth and come back with a new set of skills. So I'm going to ask the two panelists if they'd be kind enough to introduce themselves. Simon.
Thank you very much. I'm now no longer 12, but now I am the co-founder of a brand new advisory firm, and we also have a partnership in a VC fund. The firm is called 11FS, that's 11FS, and this is an advisory firm set up primarily to help people understand fintech from people that have been there and done it before. So who am I and where have I been there and done it before? So I was involved in the early setup of the Barclays Accelerator program. I worked with a lot of startups bringing them through, but my claim to fame is I built the blockchain R&D capability at Barclays, where we built a number of blockchain experiments and were rated by Business Insider as one of the top 3 banks globally for who's doing what in blockchain technology.
Perfect, thank you. And Olivier?
Yes, good morning. I spent 20 plus years in capital markets, and 18 months ago I decided to create my own company around blockchain, securities on the blockchain. It's quite a big challenge, but what I want is to really enhance the efficiency of the market, if possible, with the blockchain. And I apologize for my French accent, especially because I'm Belgian. And I look forward to the panel.
That's lovely. Thank you, Olivier. And in fact, Olivier and I both, our paths crossed many times, but we never formally met, because I was out in Paris running technology for the whole of ClearNet, and then in Brussels with Euroclear. So all post-trade. What we thought we'd do first, to help set the scene, is discuss what the scope is for settlement intermediaries. Because the subject we've got here is the blockchain the death for settlement intermediaries? So first, Simon, what's your view of what a settlement intermediary is?
Interesting. In a securities transaction, you have a number of intermediaries. So from the original buyer of a security right through to the seller, we have between 5 and 10 different counterparties in that chain. So I would see everybody as, you would think of the London Stock Exchange as being where a buyer and seller goes. That's like going to the market and buying and selling goods. However, to get into the London Stock Exchange, when you're dealing with billions, sometimes trillions in a transaction, you often need somebody to look after that money for you, because you don't want to turn up with that in your wallet. There's a big risk of having £1 trillion in your pocket. You might get robbed, or something might go wrong, or there might be some kind of risk. So that's where we have custodian banks. So famous custodian banks would be Bernie Mellon, State Street, and so on. And so now you've got the exchanges and the custodians. And then you have the prime brokers. So the prime brokers are the people who actually then sell you something for a price. They're like the market salesman. Hey, 5 for a pound type characters. And you've seen these banks and you know them well. And then so that's the sell side, as we call it. And then the buy side would have typically asset managers or sovereign wealth funds or pension funds who are looking to buy some of those securities and effectively betting against each other on given movements of certain indices. Then you may have several other intermediaries around intermediary brokers and right the way down to the retail investor or even down to a corporate investor themselves. So that 5-leg process is something that is, you go all the way up the chain from your buyer to your broker to your prime broker to your custodian to your CCP, back down to your custodian, back down to your asset manager and so on for every single transaction. Which is why doing a very basic instrument like an interest rate swap or a credit default swap, if you just kind of took it as simple as it could be, just standard indices based, can take on average, just the negotiation could take months, but once you've completed the negotiation, you've agreed what your contract is, just to get it agreed and settled with all of those different people, 90 hours. And that's an elapsed time because you're dealing in paper, you're dealing in different people's processes. Now that 90 hours costs an awful lot of money to those banks, hundreds of billions of pounds. In fact, the cost alone that one study from Oliver Wyman said just in the US, securities clearing and settlement was around $40 billion US, just in one country. So you can see why this is a prize for banks that they're looking to attack.
Thank you. And Olivier?
I think it's a very good question about replacing institutions by the blockchain, but I think it's not the full institution that will be replaced. It's a lot of functions in an institution, whatever, CCP, CSD, custodian. And you can imagine that some functions of an institution will be moved to the blockchain. Some function will stay in the institution. I'm working in Luxembourg quite a lot, and they have this transfer agency concept there. About 25 are quite major. And in fact, what's the role of them? It's a lot of computation. And the participants to the market, they're only interested in the results of it. So there is no reason moving this process that is made only by one institution to the blockchain. So I think some function will be moved to the blockchain, but none of the institutions I know today that you mentioned will be completely disrupted by a technology.
I would agree with that statement. So there was this thing where Bitcoin came along and everybody said banks are going to disappear. You will become your own bank. We will all use Bitcoin. And as time has moved on, people have gone, maybe that won't happen. Maybe we'll see a more complicated future. And I'm usually a believer that the future is more complicated than we expect it to be, and anything that's overly simplistic and idealized is probably not going to happen as much as we might like it to. So what happens with the replacement of certain bits of functionality inside organizations? Where does a blockchain really come into its own? It comes into its own where you have many complex actors performing similar tasks with each other, but that can't have a centralized body do it all for them. So think about how you might have solved the problem of having all of these actors in one transaction in the past. You just centralize it. You put it all in one bank. We have a bank for the world, and we park all of our money at that bank for the world. But what you've just done there is you've created the single biggest too big to fail bank in history, and you've created the single biggest systemic risk in history, and regulators wouldn't be very happy with you. So you can't do that effectively, even though it would be a lot more efficient, which is why often people say, well, I could solve this today with today's technology. Well, you could, but you'd have to create the biggest risk in modern history to be able to do it. So what a blockchain does is it allows me to be sure that what's in your database and what's in your database is the same as what's in my database. I call it a revolution in reconciliation. That is where blockchain really comes into its own. And I think if you think about what a lot of the slowness between these institutions, these intermediaries is about, it's about not knowing what the other person's done and where they're at in their process. Another way to think about it might be inter-organizational workflow. Having a workflow that is driven by one contract across many organizations.
Lovely, thank you very much. Having sort of set the scope, having looked at the context in that, then trying to think about what problem we're looking to solve. Now, if I go back in time, we always talked about errors, error rates, fails, manual intervention. Is that the case, or what should we be looking at in terms of blockchain? Is it the technology, or is it the problem we're solving?
So I think it's both, right? You've got to have a business case. Right? So if you're not solving a real business problem, then there's no point looking at the technology. That said, I do think people look at the technology and assume that because Bitcoin did settlement, they should start with settlement. Actually, I think settlement is one of the hardest things to solve. Because if you think about what settlement means, it's finality of settlement. That is, you have now got the money through all of these intermediaries and it is cleared and we've notified everyone we need to notify. Now, in capital markets, typically you don't put up all of your money for a trade. You don't 100% pre-fund a trade. It's like 100% pre-funding buying a mortgage. That's not the point of buying a mortgage. You don't have the cash. So you're doing different types of operation. So I don't believe that settlement is the problem, well, settlement is a problem, but I don't think it's the first problem we can solve. The problems that we should be looking at are around legal document automation. So I gave an example earlier of an interest rate swap that takes 90 hours just for the organizations to come to agreement about, have they finished updating their own internal processes. That is around errors, some of that manual processing. Some of it is around just knowing what the other person's doing. I think that one is one that you could automate relatively easily, like the reconciliation piece. So Barclays, when I was there, did an ISDA, an interest rate, the International Swaps and Derivatives Association have a standard contract for an interest rate swap. So this is like a boilerplate. It's almost like an NDA. It's very, very simple and, well, it's not simple, but it's very structured in how it's put together. So this contract typically takes that 90 hours. What if you could do it in 3 minutes? And that's what we did. With the blockchain, we got that to 3 minutes. And that's because we were driving the workflows inside of all of those organizations. And I think that's where the type of problems you're going to solve are going to come from. And I think outside of capital markets, that's the same in trade finance, that's the same in wealth, it's the same in transferring in and out of ETFs and so on.
Yeah, maybe another point I like to point out is the transparency. You know that on the core capabilities of the blockchain, transparency is one key point. And well, you go by foot home. And if you look at transparency, as a regulator, you all know how much it costs to do regulatory reporting in a year. This money, if a part of it can be made by smart contracts on the blockchain, you can reuse that money for very cost-effective and bringing added value to the market. And transparency can be a good starting point for proof of concept. And I do believe that regulator, even if they're usually known as being late on the ball, they should be the first one to launch a blockchain.
So to this point, actually, I've talked to a lot of regulators globally and central banks as well. From a macro and microprudential standpoint, the ability to know the balance sheet position of one bank against another is tremendously exciting for a central bank. Transparency, I think, is an interesting word because actually, do you want transparency? Or do you want the ability to see the positions, right? So if a blockchain is truly transparent, then you've created something genuinely dangerous. You've created something in which I can see the trades of all of my competitors and I can start to undercut them. I probably don't want transparency in a blockchain world. What I actually want is an ability to give access to data under certain conditions. And having a transactional model that shares data amongst a lot of parties, like a blockchain, could be an interesting way of architecting that. It might not be the answer, but it's certainly an answer, and I've seen some very interesting designs that do that.
And there are different levels of security on top of transparency. That's the key, is the configuration of the blockchain to find out who can see what from a B2C and B2B perspective and architecture it the right way, in fact.
And then think about the cost of regulatory reporting for banks. And if you think about what's hurting bank share prices at the moment, especially if they're in capital markets, it's that their investment bank division is suffering because of new regulations that require, one, the business they do just isn't as profitable because of the interest rate environment, but two, they've got so many new cost burdens that they didn't have before that a lot of businesses they used to be in are no longer profitable. So if they can start to automate some of that, and if they can take away some of that cost, that's tremendously exciting for those executives.
Lovely, thank you very much. I've got two rather dynamic panelists here, so what we're going to do is keep the flow going. If anyone from the floor has any questions, please, we're straight in. If we could have microphones. What we're going to do is take a couple of questions now. Gentleman there in the blue, and then lady here at the front who's filming everything we're doing. Gentleman there in the blue.
Good morning, Simon. I'd like to ask you the question in relation to does blockchain have to be global or can it be inter-country? The reason why I asked that question, I suppose everyone knows that Alexander Graham Bell founded the phone, and then when everyone used it, it became a great success. If one bank in country A uses blockchain and another bank across the Atlantic doesn't use it, can we interact?
Of course, that's a design question, right? So, as a borderline technologist, although some would claim I'm definitely not, I tend to look at things as anything is possible with technology. You can design it any way you want. So you can have a blockchain running on your laptop just for you yourself, if you want to. The question really, I think you're asking, is about the benefits. Can you get the benefits if it's just in one country? Well, that's a business case question. If 4 banks in the UK, say, were to adopt something and they saw a business case benefit in it, then yes, they would get tremendous benefit from it. And indeed, if you look at the Mansion House speech that Mark Carney actually never gave, I would encourage you to look at that Bank of England Mansion House speech. He was talking about giving central bank money access and DLT access to people who are non-banks in the UK. So the Central Bank of England certainly sees opportunity in having a national blockchain, as it were. Then you've got a second order question, which is, okay, if I've got a national blockchain, how do I make it an international blockchain? Don't know. We'll figure that one out when we get to it. But I think the first problem for a blockchain is to solve a business challenge now, and you probably don't do that by creating a digital currency for the entire world from day one. You solve a real business problem.
I don't see a location problem. What I think is we will have plenty of blockchains, but they will not be national or intra-bank or one bank. It will be asset class type of blockchains. And the key will be to make them collaborate together. Why do I say that is, if you have one blockchain per country, first of all, the blockchain is not linked to a country. We can talk about smart contracts to a country. But if you have a lot of different blockchains per country or institution, you will move the reconciliation problem to the interoperability of blockchains. And you don't solve a lot of problems. You add cost at a different level. And I think your reconciliation will be even worse at that level. So I would really recommend, and I'm discussing with some institution in France for that, it's to have asset class type of blockchains, but more than one, because if you have only one, it will be a complete mess, and the processing of it will cost a fortune, and you will kill your very small business case that you have today.
It's an interesting point around jurisdictions, because you've got two things. You've got the blockchain and the smart contract, right? These are two quite separate but quite interlinked discussions that are super important. So if my blockchain is where I'm storing the raw transactional record, the actual contract is where I'm managing a lot of workflow, and the contract has a jurisdiction. In fact, a lot of asset classes don't have a jurisdiction, so an interest rate swap only gets a jurisdiction when people start arguing about it or a dispute comes up. So to have a smart contract that says, well, now I'm going to exist in this jurisdiction, or if there's a dispute, it's in this jurisdiction, that would solve an industry challenge. And two, yes, there's so many design choices, and I think that speaks to where the industry's at. We don't know how it's going to evolve, but I like the suggestion of asset class way of doing it.
Lovely. And just before coming to this lady here, I think there's a couple of very quick ones on that. One was the fact that in equities, we already have interoperability of clearing. We have the fact that SETS, the London Stock Exchange FTSE 100, can clear either on LCH ClearNet or it can clear with EMCF, which is domiciled in the Netherlands and is now EuroCCP. Now, the issue that arose there around interoperability, which I think comes back to the point you're putting around location, was that the Dutch regulator suddenly realized that the entire London FTSE 100 market could be cleared in Holland. And were they set up, structured and organized to oversee that marketplace in that way? Very interesting dynamic for the regulator, because they benefited from demonstrating the expertise of the Dutch market, but suddenly they'd have to regulate it as well. Quite a challenge. The other very quick one is the Mark Carney paper is dated the 16th of June. It is on the Bank of England website, and the reason it wasn't given was that was a very sad day of Joe Cox passing away. So at Mansion House, he gave a speech which was a tribute to Joe Cox. But the Bank of England published it. I think it's a fantastic paper. It is the first truly demonstrable statements from governors of central banks that are significant in size, that they're giving access to central bank money for fintechs.
I was just going to say, on that question of kind of jurisdiction, it's really a question of risk and liquidity, not technology. It's what's your risk appetite as a nation and or as a bank to harvest certain amounts of liquidity and or risk on your balance sheet. That's more the question, and therefore what technology falls out of the answers to that question.
Lovely. If I may, this lady's been very patient.
Hello, my name is Victoria. I work for Cointelegraph, and I have the following question for Simon. You have already mentioned smart contracts, so I would like to know what real applications do you see for smart contracts, and what concept do you believe will go mainstream, blockchain or smart contracts?
Just one sec, if I may. In answering that, Simon, can you take us into the next topic of use cases?
Yeah, I think it does, because the second part was around use cases. So I don't see it as blockchain versus smart contracts, although I do see data layer and smart contracts being two very different subjects. So I can have a smart contract without a blockchain. It's hard to have a blockchain without a smart contract. You can kind of do it, but it's usually, even Bitcoin itself, you could argue, has a smart contract in its unspent transaction output protocol. So therefore, it's really more of a question of design choices. Do you have a public or a private blockchain, I think, is more the debate. Do you have something that is Ethereum-like and has the issues of the DAO? Do you have something that is Bitcoin-like and has issues around jurisdiction? Or do you have something that solves a given problem? And I think, honestly, it's going to come down to, are you a regulated financial institution or not? If you are a regulated financial institution, you're not going to choose an open public blockchain. You're going to choose something that you can control and manage, or that the regulators can control and manage, which is probably more appropriate. But if you're a startup and you're coming up with an entirely new asset class, who's to say that you don't build it on one of these open blockchains? In fact, maybe you do, and maybe that's a very interesting way to go. I know Tallysticks are looking at this. I know many others out there are looking at this. To name a few, Clearstream, not Clearstream, I forget the name. Oh, it's not going to come to me now. Now I start naming names. Now, smart contracts, what are the use cases? So in regulated financial institutions, I think you start with a basic interest rate swap, I think is, or any of the basic instruments around the security settlements. But I think we've overlooked the exchange-traded funds quite a bit as well. Exchange-traded funds, because you've got the fixed protocol there, you've got something in which you've got a technology protocol that can drive a bit of a workflow already. So perhaps you've got something there that you could really start to take the beginnings of the existing kind of standards that you've got and build up towards a workflow. And really, when I'm talking about workflow, I'm talking about smart contracts as being the same thing.
What is very important, I think, is to create value. Whatever use case, you have to create value. And to create value, you have to look at what kind of process today doesn't work efficiently, cost money, has a lot of manual intervention, so means error. And then you look at the business case. Mm-hmm. You're talking a lot about settlement. I made a quick study for one of my clients in France, and we were thinking of going straight to T2S or going through the CSD. And they asked me, do you think it's not better to implement a blockchain? And I say, okay, I will check. And in fact, if you look the efficiency of a market from Euronext to ClearNet until Euroclear and T2S, there is zero business case. You don't even have to think of it. The operational cost, technically it's about 45 cents. Can you imagine that after 1 billion on T2S, you decide to move a full community of hundreds of banks on a new technology for the core business to gain what? 10 cents? It's simply not making sense. So it's really finding the business case, making value, and then you can think blockchain or Oracle or SQL Server, whatever. But think of the business case first. That's my answer to your question.
Completely agree. It's about the business case. And for me, the short-term business case for banks is around back office and middle office process automation. And therefore, which asset class it's a foot race. I don't know which is going to go first. I've seen some interesting things in the commodity space, for example, gold bullion, precious metals and so on. I've seen very interesting things, even in derivatives side as well. There's a whole bunch of asset classes. And I like the idea of new asset classes. So what about trade finance as an asset class? What about diamonds as an asset class? What about sales finance as an asset class?
Crowdfunding. For example, and I finish like that, in Belgium we have a bank who's got an e-banking platform for investors, and they added the crowdfunding platform to that. And today they have built a post-trade infrastructure based on the blockchain for crowdfunding instruments. And they use it internally as an internal architecture, but as soon as they have regulatory approval, they will try to sell the post-trade architecture to different crowdfunding platforms. And I think that's where the business is, because it's a new business, there is nothing to destroy, there is nothing that works, because paying a dividend on a note of 100 euro costs you something like €1.50. So if you need something new, blockchain might be a good solution on that.
I want to change my answer to what he said. Yeah, crowdfunding platforms.
That's what I love about dynamic panelists.
Hello, my name is Charles Delaurie. I work at AXA Insurance Company. I may be a little bit late on the blockchain subject, but from what I understood out of the debate between private and public blockchain, you look to be more pitching for a private blockchain and even dedicated by asset class. Is that something that you feel is a common decision across the financial industry, or is the debate still live?
I will take the opportunity of having the same accent to answer. You have more than one answer to that. First of all, you have to look at B2C or B2B. That's the first point. And then what kind of actions do you want? What kind of transparency or what kind of business rules, smart contracts, you want to run? There is a very interesting company in the world that does diamonds, whatever. The private information that is shared between insurers are on a private network, but the public information that has to be checked by everybody about stealing a diamond or something like that is on the public. So you can imagine a full process that is composed of public data on the public blockchain and operational B2B data on a private blockchain. Today on B2B, and I've got the microphone, I keep it because he's talking a lot. And on B2B, the majority of my clients, they not even think of the public blockchain. They want a private one. They don't even need mining. They trust enough each other to have 3 or 4 validators per transaction. But on the B2B, that's like that. But on the B2C, they're looking at the public one. But the question is, how will I use the token of the money, the Bitcoin, whatever, to represent assets or to have rules associated to that?
I agree. I think Bitcoin has utility, as do most open blockchains. They have utility, and I really like the idea of considering when you'd use those and when you wouldn't use those. It's not a binary question. It's not an either-or. So, for example, to declare this diamond exists and it is not a bloodstone, there is probably no downside for everybody in the world for knowing that a diamond isn't a bloodstone. But to know who the owner of that diamond is, probably don't want that as publicly available information. So that's precisely what Everledger does. They kind of have one bit that they manage on a private blockchain and another bit that they stick out in public, and then they link the two. So from an insurance use case and asset tracking and provenance standpoint, that can be very, very interesting. On the private blockchain side, there's so many then design choices for which you're going to pick. Again, I don't think it's binary, but you can choose, the Bitcoin-based models where you've got consensus, or you can take consensus out of the thing entirely. The question really is, how much security do you want? So Bitcoin asks for all of the security of everybody in the world to validate every single transaction. The whole network has to come to consensus. But how many people do I need to come to consensus about this transaction? Maybe I just need the regulator, the buyer, the seller, then the CCPs and any intermediaries. If those are the only parties I need to come to consensus about the state of that agreement, then why am I asking the rest of the network to come to consensus about it? What am I gaining that I didn't have before? So if I've got more security and I've got more assurance and I've got more automation, then do I need public blockchains? Probably not.
No, that's lovely. Thank you very much. What I'm going to do is give both of the panelists 60 seconds to sum up.
60. Okay, start.
And at which point their microphone goes off. But I'll start with Simon, which gives Olivier 60 seconds to think through, and then I'll just close.
So Public versus private blockchain, I think the last question, it depends. And who are you and what do you want to achieve is always the first question you've got to think about. Blockchain's on a maturity curve. I think we're moving out of the POC stage. I think the terminology is starting to change into DLT and smart contracts now in the business space. There is a lot of hype out there. There are a lot of people selling this idea of blockchain without necessarily understanding it, I think. And then there's a lot of people in startups that are doing amazing things, and you should get out there and see what these startups are doing because they will surprise you and they can solve your business challenges. One of the reasons I left Barclays is because I truly believe it's a network technology, and to be in one institution isn't enough. I need to be out there talking to all of you. So please, come talk to me after the panel.
Come talk to me as well, just in case, if you want to offer me a beer. Anyway, I'm Belgian, I told you. Just my conclusion is we focus too much on technology, I think. We have to look at the standards because we can have plenty of smart contracts, but if you don't know what they're doing, what's the point? So if we don't have a business standard, a Swift, a Fix or FPML, but for smart contracts, we will go back to a time before the facts and it will bring no value. So focus on the value, make a POC and offer me a beer.
Lovely, thank you both very much for that. Just sort of drawing a conclusion on that, the impact seems to be on part of functions rather than the whole of functions. It seems to be don't look at the situation that's in front of you, actually understand what the technology can do and think about it in that context. Also within that, there are elements within this. We talked separately before the start around whether T+0 could be done. Well, we do that all the time anyway. What this potential technology gives you is the ability to go T plus whichever settlement period and whichever side of the leg of the trade you want. For those who are not capital markets, it means the freedom to be very efficient, very effective, but not to pass a significant cost on to our pension funds. I think, first of all, in closing and asking you to thank our two panelists, I will actually say that tonight, Olivier is featuring at the Hyperledger event, and for those of you who can't wait till then, Simon is live on television in the House of Lords event this afternoon. Ladies and gentlemen, my two panelists.